Hi, I'm Fallon Taylor, and welcome to MBANow. The Federal Reserve cut interest rates last month, and with more rate cuts expected, we can be sure that those rate cuts could potentially impact the CRE market. And here to discuss those implications is MBA's Head of Commercial Real Estate Research, Jamie Woodwell. Jamie, thanks for joining us today.
Great to be here, Fallon.
So, of course, the CRE market has many sectors and subsectors. But overall, how should we be thinking about what's happening in 2024?
Yeah, I think that's the fundamental question right now. And I think the key takeaway for folks is that commercial real estate is big and diverse and heterogeneous, and you can't paint the sector with one broad brushstroke. There are different property types, there are different markets, there are different submarkets, you've got different types of borrowers, different types of lenders, you've got different vintages, and each one of those properties, each one of those loans, each one of those deals is in a slightly different place based on all of those different conditions. And so what you're seeing lenders, investors, servicers do is really dig down into the specifics of every one of those to figure out what's the condition, what are the opportunities, what are the challenges for any particular set of situations.
That makes complete sense. And so furthermore, with the Federal Reserve likely continuing its rate cuts, what do you expect for the rest of the year?
Yeah, I mean, the Fed's actions are really interesting, partly because of what the Fed's doing and partly because of what it says about the economy and the state it's in and where they see it going. I think on the most fundamental level, the Fed's cuts are sort of signaling where they're taking the shorter end of the curve, the short-term borrowing, adjustable rate mortgages, that sort of a thing. And the clear direction on that is down. That the rates they've had have been really keeping 2 feet on the brakes for the economy, trying to slow down inflation while keeping an eye on the unemployment rate. As they're moving with those shorter term rates lower, they're starting to take the 2 feet off and sort of have 1 foot on the brake, moving to maybe having the foot neither on the brake or the gas. What's really interesting about that is that the longer end of the curve, so what's used to price 10-year term, 5-year terms, it's already anticipated those rates. So we saw those rates come down 100 basis points from where they were last year at this time to sort of where they've been over the last few weeks. So that's already taken into account with the longer end of the curve. And I think one of the things you've seen with that is as those rates came down, you saw a lot of borrowers sort of coming off the sidelines. People who had been expecting and waiting for those rates to come down, they saw it happen. And so we haven't seen the data yet. We'll be seeing that in the next couple of weeks, but we're expecting to see a pretty decent pickup in Q3, certainly compared to the Q1 and Q2 of this year, which remained pretty much in the doldrums.
That all makes sense, and it sounds like it's pretty good news. So for my final question, what should the industry be on the lookout for going into 2025?
Yeah, I think 2025, we're going to continue to see the reset really taking hold. And that's across different property types and their fundamentals. You know, all eyes remain on office, but we're starting to see that differentiation between properties that really there remain some fundamental questions about, and those that investors and lenders can feel comfortable about where their cash flows are, about where their fundamentals are to support mortgages going forward. You've got different property types also in some different situations with supply coming online, where's demand going to be, so keeping an eye on those fundamentals will be important. The rate situation, as we mentioned, sort of the long-term rates have really gotten to the point that they're probably expected to be over the next year or two. So that should be more sort of straight line. The short end of the curve, the Fed is signaling that they're going to be lowering rates, but where they're going to end up and the speed with which they get there is still a little bit up in the air. So that'll leave some more questions. And then with all of that, hopefully we do see transaction volume pick up. And with that, we should start to see some more transparency into where prices are, where values are. That should give more folks confidence to go ahead and transact, whether they're on the buying side or selling side or financing side, to really feel comfortable that they know where the market is and they know where a particular deal sits.
That all makes sense, Jamie, and it sounds like 2025 will definitely be a busy year.
Let's hope so.
Yeah. Jamie, thanks again for joining us today.
Thanks for having me.